The global gold mining sector in 2025 has been defined by a significant divergence between mature, high-cost producers and a new generation of agile, low-cost operators capable of maximizing margins in a record-breaking bullion price environment. Within this landscape, Artemis Gold Inc. has emerged as a premier mid-tier producer, having successfully transitioned its flagship Blackwater Mine in central British Columbia from a development stage project to a commercial operation within a remarkably compressed timeline. The investment thesis for Artemis Gold is fundamentally anchored in its ability to execute a staged, capital-efficient expansion model that leverages a Tier 1 jurisdiction, robust infrastructure, and a management team with a proven history of value creation. This analysis provides an exhaustive evaluation of the corporation's operational results, financial architecture, expansion strategy, and its valuation relative to the broader precious metals industry, synthesized through the lens of institutional risk and reward. Strategic genesis and the Atlantic Gold legacy. The foundational logic of Artemis Gold cannot be fully understood without examining the historical context of its leadership team, primarily Executive Chairman Stephen Dean, and the core executive group that previously managed Atlantic Gold Corporation. Between 2014 and 2019, this team executed a strategy in Nova Scotia that transformed a neglected set of assets into a high-margin production complex, eventually delivering a 1,129% return for shareholders upon its acquisition by St. Barbara Limited. This Atlantic Gold playbook involves identifying large-scale, lower-grade deposits in stable jurisdictions, utilizing simplified metallurgical processes, and maintaining a relentless focus on capital discipline and operational efficiency. Artemis Gold acquired the Blackwater Project from New Gold Inc. in August 2020, applying this exact framework to an asset that possessed substantial scale but required a more focused development approach. The acquisition price and subsequent de-risking activities have allowed the corporation to create significant value well before the first gold pour. By refining the project's feasibility studies and focusing on a phased development rather than a single massive capital outlay, the management team successfully mitigated the execution risks that often plague large-scale mining developments in the Canadian Cordillera.
The geographic location of Blackwater provides several strategic advantages that are frequently underestimated in global mining portfolios. Situated approximately 160 kilometers southwest of Prince George, the mine benefits from proximity to established regional supply hubs and a skilled labor pool. Unlike remote northern projects that require expensive fly-in, fly-out logistics and diesel-based power generation, Blackwater is integrated into the regional infrastructure, including a 135-kilometer, 230-kilovolt transmission line that connects the site to the British Columbia hydro grid. This connection to renewable hydroelectricity is a critical component of the corporation's cost control strategy, as it insulates the operation from the volatility of fossil fuel prices and positions it favorably within the increasingly stringent carbon pricing frameworks of North America. Geological profile and resource confidence. The Blackwater deposit is a large-scale intrusive-related gold-silver system that supports a massive open-pit mining operation. The confidence in the underlying resource is exceptionally high, a factor that differentiates Artemis Gold from many of its peers in the development and early production space. As of the 2021 feasibility study, the project's mineral reserves were estimated at 334.3 million tons, with an average gold grade of 0.75 grams per ton and a silver grade of 5.8 grams per ton. 4. This totals 8 million ounces of gold and 62.2 million ounces of silver in the reserve category alone. A granular examination of the resource reveals that 75% of the measured and indicated resources are classified as measured, which is the highest confidence level in mineral reporting. The total measured and indicated resource stands at 597 million tons at 0.61 grams per ton of gold and 6.4 grams per ton of silver, representing 11.7 million ounces of gold. 4. The scale of this resource provides the corporation with the optionality to extend the mine life beyond the currently projected 22 years, or to further increase throughput in future expansion phases.
The corporation's commitment to resource confidence extends into its operational practices. Prior to the commencement of mining, Artemis initiated an extensive grade control reverse circulation drilling program covering approximately 35,000 meters. This program was specifically designed to delineate high-grade mineralization within the first year of mill feed, with a data density 16 times greater than that of the original diamond drilling. This proactive approach to grade control has allowed the operations team to optimize the mine schedule, reduce dilution, and manage the blending of ore types more effectively. In the early quarters of 2025, the corporation reported that this strategy had already yielded favorable reconciliation, with material previously classified as waste being converted into low and medium-grade ore through better delineation of boundaries. Operational execution, the 2025 ramp-up and performance. The transition from a construction project to a commercial mine in 2025 was executed with notable precision. Artemis Gold achieved its first gold and silver pour in January 2025, following a 22-month construction period. Commercial production was officially declared on May 1, 2025, marking the successful completion of the ramp-up phase and the beginning of a sustained production cycle. The operational results for the initial months of commercial production, May and June 2025, provided the first empirical validation of the mine's design parameters. During this 2-month period, Blackwater produced 34,824 ounces of gold, with sales of 34,112 ounces at an average realized price of 4,578 Canadian dollars per ounce. Most importantly, mill throughput averaged 16,206 tons per day, which is 98.6% of its nameplate capacity. This rapid achievement of nameplate capacity is a significant milestone, as many new mining operations struggle with protracted commissioning issues in the crushing and grinding circuits. The momentum accelerated into the third quarter of 2025, the first full quarter of commercial operations. Gold production reached 60,985 ounces, bringing the year-to-date total to 124,328 ounces. The performance of the mill during this period exceeded design expectations, operating at an average throughput rate of 16,618 tons per day, or 101% of capacity. In the latter part of the quarter, specifically August and September, the mill throughput increased further to 17,248 tons per day, or 105% of design capacity.
The recovery rates for gold also showed a positive trend, improving to approximately 87% in the final months of the third quarter. The management team attributed this improvement to the implementation of a sophisticated mill feed blending strategy designed to optimize the processing of transitional ore types. Looking ahead, the corporation has set a target to achieve a sustainable throughput rate 10% above design capacity by the end of 2025. This operational outperformance provides a buffer against any potential downtime and enhances the corporation's ability to meet or exceed its full-year 2025 production guidance of between 190,000 and 230,000 ounces. Financial architecture and capital management. Artemis Gold has maintained a sophisticated approach to capital management, balancing the need for growth funding with a commitment to maintaining a robust balance sheet. In August 2025, the corporation arranged a $700 million underwritten revolving credit facility, RCF. This facility was primarily utilized to refinance existing long-term debt, providing the corporation with lower interest costs and greater financial flexibility as it enters its next expansion cycle. The financial close of the RCF occurred on September 29, 2025, at which point the corporation repaid its previous project loan facility in full. The financial results for the second and third quarters of 2025 reflect the high-margin nature of the Blackwater operation. In the second quarter, the corporation generated a net income of $100.2 million and an adjusted EBITDA of $146.4 million. The third quarter saw revenue grow to $308.1 million, with adjusted EBITDA rising to $211.4 million. This strong cash flow generation has allowed Artemis to aggressively pay down its debt obligations, with $67 million in principal payments made during the third quarter alone. As of September 30, 2025, the corporation held $75.3 million in cash and equivalents, with total available liquidity of $317.3 million. This liquidity position is crucial as the corporation begins the construction of its Phase 1A expansion. The ability to fund these expansions primarily through operating cash flows is a central tenet of the investment thesis, as it minimizes the need for dilutive equity raises and allows the corporation to retain more value for existing shareholders.
The cost profile of the Blackwater Mine is among the best in the industry. For the initial months of production, the all-in sustaining cost, AISC, was reported at $805 per ounce. While the AISC increased slightly to $840 per ounce in the third quarter of 2025, it remains in the lowest decile of global gold production. The increase in the third quarter was driven by a combination of lower silver byproduct credits, higher sustaining lease payments, and increased reagent consumption required to optimize the processing of transitional ores. Despite these factors, the AISC margin remained remarkably high at $2,374 per ounce, representing 72% of revenue. This margin provides an extraordinary level of protection against potential declines in the gold price and ensures that the corporation can continue to fund its growth initiatives across various market cycles. The Staged Expansion Strategy, Phase 1A. Artemis Gold's growth strategy is designed around a series of incremental, capital-efficient expansions that scale the production profile of the Blackwater Mine while leveraging existing infrastructure. The first of these, Phase 1A, was announced in September 2025. This expansion focuses on upgrading the current processing plant to increase its nameplate capacity by 33%, from 6 million tons per annum to 8 million tons per annum. The Phase 1A expansion is estimated to cost between $100 million and $110 million. This represents an industry-low capital intensity of approximately $50 to $55 per additional annual ton of capacity, which is a testament to the efficient design of the original plant and the foresight of the engineering team. The scope of Phase 1A includes the addition of a 3.5 megawatt vertical mill to the current ball mill grinding circuit, modifications to the cyclone cluster, and the addition of 2 new tanks to the carbon in-leach train. Other enhancements include upgrades to the oxygen supply system, the elution circuit, and the reagent delivery systems.
Construction of Phase 1A began in late 2025, with a target for completion by the fourth quarter of 2026. Because the project is being funded out of operating cash flows and focuses on debottlenecking existing systems, it carries a very low execution risk. The payback period for the Phase 1A investment is expected to be less than 6 months from the time it becomes operational, illustrating the exceptional return on capital that these staged expansions can provide. 14. By increasing the throughput to 8 million tons per annum, Phase 1A will significantly enhance the corporation's free cash flow, which will in turn be used to fund the much larger Phase 2 expansion. Transforming into a Canadian major, expanded Phase 2, EP2. The most transformative element of the Artemis Gold investment narrative is the expanded Phase 2, EP2 development, which received board approval in December 2025. 7. The EP2 project is designed to increase the processing capacity of the Blackwater Mine from 8 million tons per annum to 21 million tons per annum by the end of 2028. 7. This expansion is expected to elevate Blackwater into the ranks of the 3 largest single gold mines in Canada, with an average annual gold production of between 500,000 and 525,000 ounces for at least a decade. The capital cost for EP2 is estimated at $1.44 billion. 7. While this is a substantial investment, the corporation's capital intensity of $110 per ton of additional annual throughput is considered favorable by industry standards. 7. The design of EP2 involves the construction of a second separate processing facility adjacent to the original plant. 7. This separate facility approach is a strategic choice designed to minimize disruptions to ongoing production during the construction and commissioning phases. The new plant will feature a primary gyratory crusher, twin secondary cone crushers, and a massive SABC, SAG ball mill crusher, grinding circuit featuring 18 megawatt mills.
The corporation has already taken significant steps to de-risk the EP2 schedule. In September 2025, Artemis placed orders for several long lead time items, including an 18-megawatt SAG mill and an 18-megawatt ball mill from Metso. Notably, the ball mill was already fully fabricated due to a cancellation by another customer, which is expected to significantly shorten the procurement timeline. The front-end engineering and design, FEED, for EP2 was completed in December 2025, and early works activities are scheduled to begin in January 2026. The economic impact of the EP2 expansion is profound. At full production, the economies of scale are expected to drive unit operating costs down, cementing Blackwater's position as one of the highest-margin gold operations globally. The all-in sustaining costs for the 10-year period following the completion of EP2 are projected to be in the range of $800 to $1,100 per ounce. The project is also expected to be a major economic engine for British Columbia, creating 1,500 direct jobs during the peak of construction and 1,200 permanent roles once operational. The final investment decision for EP2 is conditional on a formal confirmation of power supply from BC Hydro, which is anticipated in early 2026. Given the corporation's existing relationship with the utility and the project's alignment with provincial electrification goals, this is viewed as a manageable hurdle by market analysts. Once commissioned in late 2028, Blackwater will not only be a cornerstone asset for Artemis Gold, but also a critical contributor to the Canadian gold mining landscape. Future upside and Phase 3 potential. While the EP2 expansion is the current focus of the corporation, the longer-term vision for Blackwater extends even further. The 2024 expansion study identified a Phase 3 target of 25 million tons per annum. Management believes this higher throughput rate can be achieved largely through continued debottlenecking and optimization of the Phase 1 and EP2 facilities, with only modest additional capital requirements. There is even potential for the Phase 3 expansion to exceed 25 million tons per annum in the future, depending on the success of regional exploration and the re-optimization of the mine plan.
Exploration upside represents a significant yet often overlooked component of the Artemis Gold story. The corporation controls a prospective land package of approximately 1,500 square kilometers in central British Columbia. In late 2025, Artemis commenced a regional exploration drill program aimed at identifying satellite deposits that could further extend the mine life or provide higher-grade feed to the expanding processing complex. Furthermore, the current mineral reserve is based on a conservative gold price assumption of $1,400 per ounce. In the current environment, where gold prices are significantly higher, there is a substantial opportunity to convert existing mineral resources into reserves, thereby extending the projected mine life and enhancing the project's net present value. Market performance and equity valuation. The market's reaction to Artemis Gold's progress in 2025 has been exceptionally positive. The corporation's share price achieved a year-to-date return of over 166% by late 2025, making it one of the top-performing gold stocks in the Canadian market. This performance has been driven by the successful declaration of commercial production, the consistent outperformance of mill throughput targets, and the announcement of the transformative EP2 expansion. As of December 2025, Artemis Gold traded at a price-to-earnings PE ratio of 41.8 times. While this is a significant premium to the Canadian metals and mining industry average of 21.4 times, it reflects the market's high expectations for future earnings growth as the Blackwater Mine scales its production profile. Many analysts argue that the PE ratio is a backward-looking metric for a company in the midst of such a rapid production ramp-up, and that the more relevant valuation metrics are based on net present value, NPV, and future free cash flow generation. Discounted cash flow DCF models for Artemis Gold suggest that the stock may still be undervalued despite its strong run. One such model estimates the fair value of the corporation at approximately $98.50 per share, which is more than 60% above its late 2025 trading price. This valuation gap is primarily driven by the massive projected cash flows from the EP2 expansion, which are not yet fully reflected in the corporation's current earnings. Analyst sentiment remains strongly bullish. Of the 23 analysts covering the stock, the vast majority maintain buy or strong buy ratings. Price targets were revised upward throughout 2025, with an average target of $32.54 by late October. High-end targets reached as high as $40 per share, reflecting the significant upside potential if the corporation continues to hit its operational and expansion milestones.
The broader macroeconomic environment for gold is also highly supportive. In late 2025, spot gold reached all-time highs above $4,200 per ounce. In this environment, Artemis Gold's low-cost profile and high production growth make it an ideal vehicle for investors seeking leverage to the gold price. Mid-tier producers like Artemis have historically delivered 3 to 4 times the percentage gains of the gold price during bull markets, and the current cycle appears to be following this pattern. Risk factor analysis. While the investment thesis for Artemis Gold is compelling, several risks must be considered. First and foremost is execution risk related to the Phase 1A and EP2 expansions. While management has a strong track record, the scale of the EP2 project is significant, and any delays in construction, procurement, or commissioning could impact the corporation's valuation. The dependency on BC Hydro for a formal power confirmation in early 2026 is a key milestone that investors should monitor closely. Operating costs and inflationary pressures also represent a potential risk. While Artemis has successfully maintained a low-cost profile to date, continued increases in the costs of labor, reagents, and electricity could impact margins. The corporation's recent warning letters from the EAO also highlight the regulatory risks associated with environmental compliance. While these issues appear manageable, any significant environmental incident or persistent non-compliance could lead to fines or operational disruptions. Currency risk is another factor for Canadian-based producers. While gold is priced in United States dollars, a significant portion of Artemis Gold's operating and capital costs are denominated in Canadian dollars. A strengthening of the Canadian dollar relative to the United States dollar would increase the corporation's reported costs and reduce its margins.
Conversely, the corporation's recent use of zero-cost gold collars was designed to mitigate some of the price volatility during the ramp-up phase, but it also means the corporation did not capture the full upside of the gold price on its hedged ounces.
Finally, the silver stream agreement with Wheaton Precious Metals, while providing important upfront capital, means that Artemis will not capture the full benefit of rising silver prices on a portion of its production. As silver prices reached record highs above $60 per ounce in late 2025, the opportunity cost of this stream becomes more apparent, though it remains a common and effective financing tool in the industry. Conclusion. Artemis Gold Inc. represents a highly attractive investment opportunity within the precious metals sector. The corporation has successfully navigated the high-risk transition from developer to producer, validating the Atlantic Gold model at a much larger scale in British Columbia. The operational outperformance seen in the early quarters of 2025, characterized by mill throughput exceeding nameplate capacity and industry-leading margins, provides a high degree of confidence in the mine's long-term potential. The staged expansion strategy is defined by capital discipline, by using the free cash flow from the current operations to fund the Phase 1A and EP2 expansions. Artemis is building a world-class production complex with minimal equity dilution. The expanded Phase 2 project is particularly transformative, positioning the corporation to become a top-tier producer with over 500,000 ounces of annual production at some of the lowest costs in the world. While the current valuation reflects a premium multiple, it appears justified by the corporation's growth profile, the quality of its management team, and the scale of its Tier 1 asset. For investors seeking exposure to the gold sector, Artemis Gold offers a combination of significant production growth, exceptional margins, and a stable, low-risk jurisdiction. The long-term upside, driven by exploration potential and future Phase 3 expansions, suggests that the corporation is only at the beginning of its value creation journey. The corporation's ability to execute on the EP2 project will be the primary driver of its valuation over the next 3 years. If management continues to deliver on its stated objectives with the same precision they applied to the Phase 1 ramp-up, Artemis Gold is well-positioned to become one of the most significant and profitable gold producers in the global mining industry. The convergence of record gold prices, low-cost production, and a clear path to major expansion creates sustained value creation for long-term shareholders.